Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about Bitcoin and altcoins, how to invest in a bear market, so make sure to watch the full video. Bitcoin, BTC, is down almost 40% year-to-date, while most leading altcoins have dropped 50% to 70% since the start of 2022. So it's fair to say, however, that doesn't mean you have to exit the crypto markets because we're having a bad first half of the year. Read on to learn how you can weather the storm in the current crypto market climate. What's been happening? The crypto markets have cooled off to start this year, following a record year in 2021. Last year, we saw record-high crypto prices, an exploding NFT market with JPEGs selling for millions, and a burgeoning DeFi market expanding beyond altcoins and becoming multi-chain. Today, the situation is different. We have dropped sharply off the all-time highs, while BTC and altcoins managed to only lose around 60% of their value since their highs. Numerous leading altcoins have lost more than 90%. The recent collapse of USD and Luna has sent prices crashing, as investors received a stern reminder of how risky crypto assets can be. Needless to say, crypto investors are feeling uneasy. According to the Crypto Fear and Greed Index, they're actually extremely fearful. But that doesn't mean investors have to leave crypto and wait for the next bull market to jump back in. What can crypto investors do now? It has been a difficult year for crypto investors. Well, stock investors too, especially those who have only entered the market recently and are experiencing their first market downturn. Let's take a look at what investors can do during this crypto bear market. Move into high-quality assets. If you aren't that bearish and are worried you might miss out on a market turnaround, you could move your funds away from small and mid-capitalizations coins into higher-quality assets, such as BTC and ETH. While the upside during a bull market may not be as high as with the latest Layer 1 or Base protocol chains token in the past, the BTC and ETH losses were lower in comparison to smaller altcoins. Alternatively, you could sell everything for Bitcoin and start dollar-cost averaging the cryptocurrency to slowly rebuild your digital wealth in what is arguably the highest quality asset in the crypto markets. Buy put options to hedge against a further drop in prices. If you would like to hold on to the assets you have in your portfolio, but are worried about the market moving lower, you could hedge your portfolio by purchasing put options on BTC and altcoins. Buying put options on Bitcoin enables you to sell BTC at a predetermined price at a specific time in the future. If, for example, you purchase an option with a strike price of, let's say, USD 20,000 and the price drops to USD 10,000, your options hedge will be in the money, as you will sell BTC for USD 20,000 while buying it for USD 10,000 to offset the losses in your crypto portfolio. However, you will need to ensure that your hedge ratio is correct, so you will need to buy enough put options contracts to offset your potential losses. Should the price of Bitcoin not drop below USD 20,000, your options contracts will expire, and you will lose the premium, i.e. the price you pay for them. In a sense, put options act as an insurance contract against losses in portfolio value. HODL, diamond hands. Finally, if you are convinced of the future success of the crypto network's assets you are holding, you could also just HODL your portfolio and wait out the bear market. In addition to HODLing, you could also buy dips in the assets you believe in the most. This will arguably be very difficult for newcomers, as it's hard to see the light at the end of the tunnel during the first crypto bear market. But if history repeats itself, many of the crypto assets that have dropped over 90% since their highs may reach new highs again. However, as always, there are no guarantees about the future, therefore, invest only what you can afford to lose. 7 ways to invest in crypto bear market. It may sound a little harsh to generalize along those lines, but as the saying goes, even a fool can make money in a bull market. The proof of how good a trader you are lies in how good you are navigating a bear market. This generally agreeable rule of thumb is applicable across all markets, not just crypto. However, With the kind of volatility crypto usually undergoes, the risks and difficulties brought along by a crypto bear market tend to be on a much higher scale. And as we witness the possible onset of another crypto winter, with most of the popular coins knee-deep in the red, it's time we optimize our trading investment strategies with the following tried and tested ways to survive crypto bear markets. 1. Stay calm and assess your options. Whether you see the bear market as an opportunity to buy the dip or find falling crypto prices a bit too stressful to handle, always try to keep your calm and assess the situation objectively. Emotional decisions are the ones that you will most likely regret down the road, especially if you're trading. First, start by asking yourself why you are invested in crypto in the first place. Do you believe in crypto's long-term success and want to tap in on the many opportunities that it could bring along? Or are you just here to earn some quick bucks doing short-term trading? The answer to this question could be your stepping stone to figure a way out of the bear market unscratched. 2. Don't try to time the bottom. Nobody, absolutely nobody, can accurately predict the bottom. You could study technical and fundamental analyses all you want or listen to experts, but at the end of the day, you may still have to rely on your gut feeling while trying to time the bottom. And as you will probably agree, gut feelings are not much of an option if you're looking for strategies to navigate a crypto bear market, or worse even, a crypto winter. You may buy at what appears to be the bottom at a given time. However, the price could further drop, and if it does drop, you will have to sell again to have your next shot at timing the elusive bottom. More often than not, this strategy will only cause your wallet to shrink. 3. Dollar cost averaging, DCA. Dollar cost averaging, or DCA, is arguably the best strategy that is proven to have worked exceedingly well even during the toughest of bear markets. It is a simple but long-term strategy where you continue buying small amounts of an asset over a period of time regardless of the price. For example, a DCA schedule will have you investing, say, $50 on Bitcoin every week rather than investing $200 at once. You may make changes to your DCA schedule from time to meet your changing requirements. So, continuing from the example above, suppose you started buying $50 worth of Bitcoin every week 3 years ago. By now, you would have invested $7,850 in Bitcoin over these 3 years. Now, using a DCA calculator, you will find that the total value of your investment would currently stand at $21,777. That's a sizable gain of 177.42% percentage chain over 3 years. 4. Consider staking. When the going gets tough in a crypto bear market and your portfolio starts shedding value left and right, staking comes off as a good way to earn a passive income from your crypto stash. Staking basically refers to the practice of locking away your coins on a proof-of-stake (POS) blockchain for a period of time and being rewarded for it. For those out of the loop, this detailed guide is a good place to start if you want to learn more about staking crypto. The best part about staking is that it increases the size of your wallet, even in a bear market. That way, when the bull market resumes, you start with more than you had previously. Besides, staking also lowers the possibility of panic selling because your fund is securely locked on a blockchain. Avoid shorting in a crypto bear market. Shorting is a technique traders use to profit from falling crypto prices. That should ideally make it an excellent fit in a bear market, when price drops are a common occurrence. However, you would find most experts advising against shorting Bitcoin and other cryptocurrencies because it could potentially lead to unlimited losses or liquidation of your position. This is a fundamental problem with shorting, and no amount of experience can prepare you for the rude shocks when things go bad. When you buy a crypto, go long. You can never really lose more than the amount you have invested. For example, say you have purchased BTC worth $100 so. The maximum you could lose from that investment is $100. On the other hand, the potential gain, at least on paper, could be limitless. Think of a scenario where the BTC price increases so much that the $100 investment returns $500, $1,000, $10,000, and so on. It's just the opposite with shorting. If you short a coin at $100, The maximum you will earn from that trade is $100. However, if the price of the crypto starts increasing and the uptrend continues, your losses could pile up indefinitely. And if you short using margin, you will have to keep paying the interest charges on top of the original loss for as long as you choose to keep the position open. 6. Carefully assess the current state of the market. As of mid-2022, in the middle of the current bearish trend, Bitcoin seems to have found major support near $30,000. This support is expected to hold the fort for a while, given that several big institutional investors bought within this range. Meanwhile, other indicators suggest that a big chunk of new investors who probably bought near the top have already sold most of their crypto amid fear, uncertainty, and doubt. FUD. Their exit from the market at this stage could further stabilize crypto prices. The point here is that it is important to stay updated and have situational awareness about the current state of the market. This way you stand the best chance to position yourself accordingly, act quickly, and minimize losses. Avoid leaving your crypto on exchanges. Like they say, not your keys, not your coins. This is applicable in pretty much any scenario involving a centralized, custodial crypto exchange. However, the risks of irretrievably losing your funds stored in these exchanges become even bigger during a turbulent bear market. Consider what might happen if there was a sudden market crash. Billions of dollars would be wiped out from the market, causing many exchanges to end up insolvent. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.